Thank you for the gracious invitation. Hopefully we can throw a little light on a couple of things. By the way, anyone in the audience can feel free to laugh at the name of an analyst being Steele, who covers the precious metals and particularly the gold market. Well, gold is a geopolitical metal, and what I wanted to relay here is that it does react to geopolitical events. Now, any one particular event it might not react to. For example, it only rallied $10 during Brexit, and then it came back. So sometimes I'm asked the question as, Jim, is it really sensitive to geopolitical issues? But there's a good study out, Gold and Geopolitics, and it shows that it's not so much any particular event, it's the frequency of these events. And what is classified as a geopolitical event, which is an event that has regional or international dimensions, more of these are occurring. More have occurred this year than the year before, and we expect more to occur further, according to the IMF. Now, this is interesting because it's going to put something of a floor on gold, because gold is good in a measure of uncertainty. Now, the other important thing that helps drive gold is monetary policy. I could have put in a lot of different central banks here, but I kept it to Fed. And as we've seen monetary accommodation, as we've seen unconventional policies, MMT, which was talked about, mentioned earlier in the introduction, gold has been sensitive to that, has moved up quite sharply. This is especially the case because it is not just the Fed that's easing. This is combined with many other central banks, and the fact that given Jackson Hole and the comments made there, we're going to see this accommodation persist for quite a long time. And this just shows the U.S. yield curve. And as it's flattened because of accommodation, gold has done particularly well. The next slide will show this very clearly. This is the 10-year yield, the U.S. Treasury, in real terms, put up against the gold price. We've inverted, of course, the yield. And as it gets more negative, the gold has been supportive. Now, we have negative yields in many parts of the world, and sometimes in nominal terms as well. So we have a large slice of sovereign debt that is negatively yielding, and we have negative real yield basis the U.S. 10-year. The 10-year offers the best fit with the gold price. So if one were to think that the situation is going to remain around these levels, then one would argue that gold would be well supported. Our forecast, by the way, is from Stephen Major, is for 50 basis points in nominal terms by the end of the year and low levels for next year. This would argue for support of gold price. Well, the other thing, debt likes two things. It likes liquidity, but it also likes debt. And the increase in fiscal spending as a consequence of COVID, and the monetary reaction was the consequence, obviously, the reaction to COVID as well. We see here that debt is going up, private debt is going up, and public debt is going up. I mean, here we see the projections of back in 1990 just a couple of years ago, the percentage of debt, the debt to GDP ratio, and it's rising. We're at levels now in the United States that we haven't seen since 1944, 1945, the end of the Second World War. Similarly, with other OECD countries, debt is rising rapidly. I think it's intuitive as to why one would see higher gold prices with greater liquidity, with more easing. Maybe it's less clear with greater fiscal expenditure and greater deficits, but greater debt burdens makes it more difficult to recover from a recession. There's also the possibility that debt one day could be monetized. It has, we're not suggesting that, but it is a possibility. Also, debt impacts the financial markets. It restrains consumer spending, and all of these things might require more monetary easing. And what is interesting about the current situation, and it's likely to persist for the next couple of years, is that we're seeing monetary easing along with an increase in fiscal spending. So the two together are having this impact on gold, and that usually doesn't happen. Usually we don't get both of them together. Sometimes one will actually adjust because the other is increasing. Here's how it's translating into the markets. The net long positions on the COMEX are quite high. And in addition to that, the ETFs, which the World Gold Council and the HSBC pioneered, we have an astronomical jump. And I don't say that lightly. We've gone from 81.5 million ounces at the beginning of the year to 110 million ounces currently. And we've also seen net positions on the COMEX stay at very high levels. Here is the proof of the pudding. Here is a correlation. The R squared here is almost 90.9. This is the two largest ETFs and the change in them against the gold price. That's a beautiful, beautiful fit. If one thinks that the ETFs will remain at least reasonably well bid, then this is supportive. Well, you know, one of the most difficult things about being a precious metals analyst, particularly for gold, is to be original. It's quoted dozens of times in the Bible, as is silver. It's quoted in other religious texts around the world. And we've been writing about it for 5,000 years. And I thought I would show it against trade. I thought that might be something unusual. And the data goes back much further, but I took it about 10 years. When the world trade is rising, economists tell us a number of things happen. One is that inflation falls because the cheapest goods and services are being traded. Investment rises, cross-border investment and immigration rise. Equity markets tend to be strong, led by export-led companies. The dollar tends to be strong because you need the dollar to trade. Unemployment falls, and because of comparative advantage, global growth rises. So in that situation, you might not want to own a lot of gold, and geopolitical risks decline because you don't go to war or have currency disputes with countries that you trade a lot with, usually. So you wouldn't want to own a lot of gold, necessarily. But when trade contracts, the gold market moves very quickly. There's a bit of a lag, but it does move, and it stays strong. And if you see here, for the major trading blocks in the world, trade remains low, and the gold market has been very strong. If you think we're going to continue to have issues with trade, no matter who occupies what office in any country going forward, we could very well be well supported. This is data from the U.S. Mint showing coin demand. The U.S. Mint is publishes regular data. It's also the largest producer of gold and silver coins. And as you run into a U.S. election, the coin demand drops. And it has been very, very strong recently. Now, when Donald Trump was elected, we had a drop in coin demand, which lasted for some substantial time after that. But other mints have had business that was more steady. But I just think this is interesting because, again, it brings in the political dimension. Bar demand has also been quite strong. Well, we've painted a pretty bullish argument, but the whole argument is not bullish, and we always try to be balanced and fair. And the give in the market has been jewelry. 50% of world demand is absorbed by jewelry, usually. But we have had a drop in jewelry demand of 50% in the first half of the year, roughly. This is data from our good friends at the WGC for their excellent demand trends publication. Now, we're forecasting beyond that, and we continue to see weak jewelry demand. Now, it's logical because the bulk of jewelry demand is bought in the emerging world, and much of that, two-thirds, is between India and China. So we do really have a significant amount of gold there, and that has been pulled back. Gold jewelry demand that we usually see, that has been pulled back. And that is where the gold in the ETFs is going. Not the same physical gold, but that is where the gold is supplied from. Now, we've also seen an increase in recycling, and that's important because at these prices, recycling is going to be high. I just want to make the point that a lot of gold bars that are bought in India are only 10 grams. So it's not by people of relatively modest incomes in the emerging world. So when you get a price increase, it feeds through very quickly. The markup in gold jewelry in much of Asia is also quite low compared to Western markets, which is why you see the price change quickly in the shops, and why we will have a dramatic impact on jewelry demand and also on gold demand in general. And if you look at it in local currency terms, because the dollar has been relatively strong for a while, then you see, again, these are high local currency prices, and that's important. And here we see, in the case of weak imports into China, the imports have dropped off. Now, there might be other reasons for that, but generally speaking, you see that they've been able to satisfy their own demand by domestic production and recycling. And that supports the weak jewelry argument. Here we see a similar issue with India. The demand has fallen because of the high price. Imports are beginning to recover, but it's important to keep that in mind. And my final slide is on central banks. We've had 2 record years of demand for central banks, and central bank demand has fallen notably. The Central Bank of Russia, I believe on April 1st, said that they would not import any more gold this year. Other major central banks have been out of the market. This is because a lot of them use petrodollars. A lot of it's from great oil exporting countries, and the lower oil price has fed through and reduced the amount of dollars that they're willing to buy gold with. The other issue, too, is the decline in trade, getting back to trade again, and the slowdown in world growth has reduced current account surpluses in a number of great exporting countries, and that in turn has reduced the amount of dollars that they're willing to spend on the gold front. So, we see geopolitical risks, we see the twin engines for gold demand of debt and liquidity fueling demand, but it's been through the investment side, it's been through the ETFs, bars, coins, and we have seen a drop-off in jewelry demand, which I think it will recover from the levels that it's at now, but it will remain depressed. And we have an increase in recycling and more restrained central bank buying. So that is why, although we are bullish on the gold market, we point out these headwinds from a case of giving a balanced view. That finishes my presentation.